What if I told you that a single institution now holds more silver than entire nations, entire industries, and most retail investors combined? Nearly 750 million ounces, enough to blanket the world's industrial supply, for years are quietly stacked in vaults, while the mainstream market keeps talking about prices as if nothing has changed. For over 15 years, this entity allegedly manipulated prices, pushing silver down while quietly accumulating real metal. And now, that same force has flipped the script entirely, transforming from a market suppressor into the ultimate holder, controlling the physical flow of the market itself. Time is not on your side. A Chinese export ban is set to start in just days, threatening to cut off one of the world's largest sources of silver. Every ounce becomes harder to access, every delivery backlog grows, and the market begins to feel the weight of real scarcity. Industrial giants Tesla, Apple, BYD are suddenly negotiating with the holders of this metal at prices far above paper contracts. If you're watching this, you might be seeing the final accumulation before a historic shortage. This isn't theory, it's structural reality, and understanding that reality is the only way to know why the coming weeks could define the next decade of wealth transfer. We dive into the stark contrast between the paper markets the mainstream reports on and the physical silver reality stacking up behind the scenes. Most investors think silver trades like any other commodity. Prices move up and down, and contracts settle cleanly. But the reality is far more unsettling. On paper, billions of ounces change hands daily on COMEX and LBMA, yet only a fraction actually exists in physical form. This gap has allowed institutions to manipulate supply and suppress prices for years until now. JP Morgan, once a key suppressor, has quietly shifted into the world's largest physical holder. The very bank that drove prices lower is now controlling access to real metal. Industrial buyers are the first to feel the pinch. Tesla, Apple, and BYD aren't buying futures they need, tangible silver for EVs, batteries, and solar panels. And with JP Morgan controlling supply, these companies are forced into negotiations at premiums far above paper prices. Meanwhile, retail investors watching COMEX quotes may not even realize how distorted the market has become. The contrast is stark. Paper silver is a promise. Physical silver is reality. And this disconnect is not just a quirk, it's the trigger for institutional moves that could redefine ownership of the market entirely. We'll uncover the signals that indicate these moves are already underway. The market isn't just shifting, it's flashing red alarms. The first and most visible trigger is China's impending silver export ban, set to take effect in just days. One of the largest suppliers in the world is about to cut off physical flows, instantly tightening the global supply. At the same time, repo injections in the US have surged, revealing stress and liquidity and signaling that major institutions are scrambling behind the scenes to secure metal. And then there's the Shanghai silver premium it climbing week after week. Paper prices may still hover in a narrow range, but physical buyers are paying sharply higher rates just to get delivery. Delivery queues lengthen, warehouses report shortages, and arbitrage that once allowed traders to exploit price gaps is now broken. Industrial giants and speculators alike feel the pressure. There's simply not enough metal moving freely. For investors watching from the sidelines, the warning is clear. The window to acquire physical silver at reasonable terms is closing fast. This isn't speculation, it's a structural squeeze. We'll examine the hard realities of supply and why industrial demand makes these shortages unavoidable. The crisis isn't coming, it's already here, and it's physical. Global mine production barely scratches the surface of total demand, producing roughly 25,000 tons annually. Meanwhile, industrial consumption is surging. EV manufacturers like Tesla and BYD need silver for batteries. Tech giants like Samsung and Apple required for semiconductors and electronics. Solar panel production alone consumes thousands of tons each year. Even defense and aerospace sectors rely on silver's unique properties. Substitution isn't an option. There's no metal that can replicate silver's conductivity, reflectivity, or chemical stability at scale. Every ounce in a vault, every ounce in transit, is suddenly priceless. And with JP Morgan now controlling a significant portion of physical silver, industrial buyers are effectively at the mercy of a gatekeeper, negotiating at premiums far above paper prices. For retail investors, this is a wake-up call. The market isn't just tight, it's structurally incapable of satisfying demand through production alone. Stacking silver isn't speculative anymore. It's a hedge against industrial and systemic shortages that could explode at any moment. We'll uncover the systemic risks lurking behind the banks and Fed actions, where leverage, derivatives, and policy missteps amplify this physical squeeze into a financial crisis. Behind the headlines, a dangerous financial loop is forming. Banks are sitting on massive paper positions, leveraged beyond reason, while central banks pump liquidity through repo injections to stabilize the system. But each injection only masks the growing gap between paper promises and physical reality. Repo spikes show stress in short-term funding, hinting that even institutions may struggle to deliver metal when contracts come due. Meanwhile, some banks hold shorts that are effectively bets against the very metal they are now forced to supply. Central bank policies simultaneously encouraging stability while hoarding physical reserves create contradictions that worsen systemic strain. It's a classic doom loop. The more institutions scramble to cover positions, the tighter physical supply becomes, which in turn drives premiums higher, fueling panic among industrial buyers and retail stackers alike. This isn't theoretical risk. It's structural and immediate. Paper markets cannot bend the laws of supply and demand. When these financial engines collide with the physical squeeze, the result is a cascade that could ripple across currencies, commodities, and markets worldwide. We shift from the mechanics of finance to the global stage geopolitics and the emerging post-dollar regime that are shaping this silver crisis. This isn't just a market story, it's a global power play. While Western markets focus on price charts, the East is quietly accumulating real assets. BRICS nations, led by China, are stockpiling silver and gold, positioning themselves to reduce reliance on the US dollar. The looming Chinese export ban isn't just a trade restriction, it's a strategic move that shifts physical metal from Western industrial users into Eastern vaults. Central banks are also accelerating accumulation, with gold buying signaling a broader push toward tangible assets as trust in fiat erodes. Meanwhile, digital currencies, CBDCs, are being rolled out across Asia, reinforcing control over money supply while highlighting the divergence from Western financial norms. Every ounce physically hoarded in the East translates into scarcity for the West, creating a new battleground for silver and gold ownership. For retail investors, this is revelation and empowerment. The crisis is global, but understanding who controls metal and where it's moving reveals where opportunity lies. Physical silver isn't just a hedge. It's a ticket to participate in the next monetary regime. We'll break down exactly what this means for you personally, how to position, stack, and act while the window of opportunity is still open. The time to act is now. Physical silver is scarce, premiums are climbing, and delivery queues are lengthening, especially in Shanghai, where buyers are paying far above COMEX paper prices. For anyone serious about preserving wealth, allocation strategy isn't optional. It's survival. Prioritize tangible assets over futures contracts or ETFs, because paper can't deliver in a squeeze. Track premium spikes, monitor delivery backlogs, and watch policy announcements from China, the Fed, and central banks. They read the signals that tell you when the next wave of institutional buying hits. Stacking isn't just about accumulation, it's about positioning. Diversify between silver and gold, balance timing against premiums, and understand industrial demand pressures. Avoid chasing the paper market or relying on broker promises. Focus on what you can hold in your hands. Every ounce secured today reduces exposure to both systemic risk and sudden price surges tomorrow. This is your opportunity to act alongside institutions, not after them. The next section will bring it all together, the final rally. The wealth transfer and why holding physical metal now could define your financial trajectory for decades. We are at the edge of a historic wealth transfer. Institutions, nations, and strategic buyers are moving decisively into physical silver and gold, and the next wave of scarcity will reward those already positioned. The arbitrage that once allowed paper markets to mask shortages is broken. Delivery backlogs, Shanghai premiums, and policy shifts are accelerating the shift from fiat promises to real metal. For viewers, this is more than opportunity, it's protection. Every ounce stacked today is a hedge against systemic risks, currency debasement, and industrial scarcity. Weighting risks, losing your place alongside the institutions and global buyers now controlling supply. The coming months could define who participates in the next monetary regime and who watches from the sidelines. Act decisively, diversified allocations, secure physical metal, and stay vigilant on premiums and policy signals. Stack strategically, stay informed, and position yourself not just to survive, but to thrive as the financial landscape shifts dramatically around you.